Hi, my name is Hilary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants and Lightpoint Portfolios. And this is your February 2022 market update. Well, given the events we've seen with Russia and Ukraine over the last week, I'd like to walk you through what we are doing to distinguish what types of impacts it's going to have, not only on the capital markets, but also on the U.S. economy. As you've probably seen, the situation in Ukraine has deteriorated rapidly. Russia officially recognized areas controlled by separatists as people's republics and immediately moved forces to the region. Shortly thereafter, Russia unleashed a multi-front invasion of Ukraine, as shown by the red shading here, with targets including the capital city of Kyiv. It's unclear whether Russia intends to absorb Ukraine or to install a puppet government and run Ukraine as a vassal state. However, historically, Kyiv was an important cultural center for Russia, and it has become clear that Russia intends to regain control of the capital city. The US and Western allies have responded with numerous sanctions, including cutting Russia off from SWIFT, the global system that is vital for banks to carry out secure transactions. And this is now hobbling Russia's economy. Russia's central bank had to hike its key interest rate to an astonishing 20% as it grapples with ways to prop up its currency, the ruble. The last time interest rates were near this level was back in 2014 when Russia annexed Crimea. At that time, the Central Bank of Russia had to raise interest rates to 17% to prop up its currency. For investors in Russia, the losses have been substantial, as you can see here. This is a look at one of the ETFs that invest in the Russian stock market. Following the U.S. economic sanctions on Russian corporations and banking entities, the closure of the Russian securities market, as well as Russian government-imposed capital controls, the liquidity of Russian securities has virtually dried up, and its currency has experienced significant declines. The Russian stock market is now closed in an effort to limit further stock market turmoil. It's important to note that while Russia is a large country by land, it's not very large in terms of the global stock market. Russia is known as an emerging market, and within emerging markets, Russia comprises about 2 to 3% of an emerging market stock index. So investors who are properly diversified globally have very little exposure to the country. And if you just think through the math here with me for a minute, assuming you have a 7% allocation to the emerging markets asset class, if that fund you may be using invest 2% of it in Russia, then 0.14% of your portfolio could possibly be invested there. And so from an investment perspective, I would say that most investors probably have little to no exposure to this country. However, while you may have little, if any, direct exposure to Russia within your portfolio, the domestic stock markets have still responded to the geopolitical events with a return of volatility. Now, it is important to note that the S&P 500, which is a measure of the performance of the largest stocks in the United States, was already in negative territory year to date prior to the invasion of Ukraine on February 24th, as shown by the crosshairs there. Concerns over inflationary pressures, particularly in the United States, and the potential for the Federal Reserve to raise interest rates more aggressively than anticipated were the primary drivers of market volatility for the first 6 to 7 weeks of the year. We do anticipate that the invasion of Ukraine will continue to impact the markets. While Russia accounts for only 0.1% of sales to companies in the S&P 500, the country does control big segments of the commodity markets, which were already experiencing low inventories worldwide. Russia is the second largest oil exporter in the world and is also a major exporter of natural gas, particularly to Europe. While energy prices have already been pressured higher over the last few months, the conflict has caused further price pressures, with Brent oil prices topping $100 per barrel for the first time since 2014. Also, Russia accounts for 6% of global aluminum and 5% of global nickel supply, and inventories of those base metals were already extremely low, which leaves very little additional cushion for further supply chain disruptions. So overall, the conflict is likely to add to inflationary pressures in the energy markets and the base metals markets, but additionally in food prices as well. Ukraine is a net exporter of wheat, and disruption to the wheat supply coming out of Ukraine could have a significant impact on wheat prices. And additionally, Russia and Belarus are the second and third largest producers of potash fertilizer in the world. Belarusian potash exports were already sanctioned, which, if combined with weaker wheat supply from Ukraine, has global inflationary implications. And this is why we remain positioned in asset classes that have historically performed well in inflationary environments. But overall, the degree of the impact from this conflict on risk assets largely depends on the Western response, which in turn depends on the severity and duration of the conflict itself. A protracted occupation could possibly result in counterinsurgency measures by Ukrainian allies, and that is a scenario that nobody is wishing for. That being said, I wanted to show you from a historical perspective how markets typically react to geopolitical events. This graphic illustrates what has happened to the S&P 500 index on the day of a major geopolitical event, how far the market dropped, and how long it took to fully recover. The two biggest drawdowns occurred due to the attack on Pearl Harbor and Iraq's invasion of Kuwait, 19.8% and 16.9% drawdowns, respectively. And those took about 6 months for the recovery to happen. However, it's important to note when looking across all these geopolitical events here, the average drawdown is just shy of 5%, and the drawdowns were relatively short-lived. On average, it has taken 3 weeks for the market to reach a bottom and about 6 weeks to recover those losses when it comes to geopolitical events. Now, that's not to say that this event will be less significant, but history suggests that we should not jump to worst-case scenarios when an event like this occurs. Staying invested in a diversified, goals-aligned portfolio has paid off through countless geopolitical crises throughout history and should continue to do so. I like to compare the type of market volatility we've been experiencing this year to experiencing turbulence on an airplane. Inexperienced flyers often panic when the plane hits a little bit of turbulence and starts bouncing around, but the pilot and the crew just take it in stride. They know that turbulence happens every now and then, and it's a normal part of flying. And stock market volatility is also normal as well. As an investor in the stock market, you should be prepared to ride out these bouts of volatility. On average, the stock market has 3 5% pullbacks per year, 1 10% correction per year, a 15% drawdown every 3 years, and a bear market, which is defined as a drop of 20% or more once every 6 years. So one of the most important things that you can do as an investor is to stay calm during the volatility and allow us to fly the plane. Ultimately, the market is driven by the economic landscape and company earnings and not by geopolitical events. So what are we doing about this conflict right now? Well, as a fiduciary and steward of your assets, we are investing in businesses that we expect will continue to grow and to prosper over the long run. And we've already positioned portfolios in asset classes that we believe will weather the storm. For example, we've already hedged some of the risk of both stock and bond markets by investing a portion, most of our portfolios, in alternative investments. Within these investments, you have exposure to commodities such as oil, agricultural products such as wheat, precious metals such as gold. You also have exposure to asset classes that perform well in scenarios when expected inflation is high, such as in real estate investment trusts and treasury inflation-protected securities. And additionally, we have investments that can actually short the market, meaning that we can profit when the market goes down. That being said, we recognize that in the short term, this is a highly uncertain event that is likely to result in significant volatility and periods of indiscriminate selling. But we are investing portfolios for what we view as the most probable outcome, and will make changes to the portfolios as warranted. And finally, we do recognize that this is a humanitarian disaster. We hope and pray that there is swift resolution to this conflict that minimizes human suffering. As always, we thank you for your confidence, and please reach out to us with any questions that you may have.